One of those alts or alternatives, Rob, is private debt right now or corporate debt. You're hearing like with all the interest rates, some of the debt, like there's some issues with private debt. Some of the stuff you're dealing with, you don't seem to have that large reward at all. Tell me what the disconnect is that most people aren't hearing about.
Sure. Yeah. Private credit has been a buzzword for the last 2 or 3 years, let's say, as liquidity within banks and traditional financing got a little bit tighter,
Yeah.
people started to lean into private markets to create private debt or private credit. The universe of private credit is as big as, let's pick on equities, for instance. There's private equity, there's public equity. Even within public equity, there's a slew of different options, different categories, different, business lines or things that you can invest
Share
in.
classes.
Share classes. Private credit is no different. So when people talk about private credit being in jeopardy at this moment, they're referring to private debt to businesses. Businesses that, for one reason or another, struggled to get financing or debt from a traditional channel, whether it's a bank or maybe they be raising, for a bond or whatever it might be. Um, when you're looking at private credit, you need to pay really close attention to what collateral is backing the loan that's being made. We are not worried about our private credit at the moment because what we're focused on is residential real estate in the Boston market. When we underwrite a loan, typically we're looking at 70% loan to value, but across our entire portfolio, we're only at 65 or 60% loan to value. It's a very different universe than what people are talking about when they say, we need to pay attention to private credit and there could be some risk on the table here.